We just heard from the Deputy Prime Minister of Malaysia how Malaysia is navigating both the US and China. I'm just wondering, when you take a look at the trade deals that have been negotiated in this part of the world, can you see who are the potential winners and losers so far?
Well, so far, I think the U.S. has been a winner to a great extent, because if you notice the meeting that she had with Trump, Trump came out ahead in the sense he walked away with what he wanted. That was soybean exports to China. You know, the American farmers are very important to elections. So that was one thing. And of course, the rare earth release by China, that's another thing. So a number of things happened between Xi and Trump, which put the U.S. in a much better position. And of course, as you know, Trump's visit to Southeast Asia was also very, very good. And then, most important of all, his trip to Japan put China in a, I would say, pretty bad position. So a lot of things are happening. I think most important thing that is the changes within the CCP, the Communist Party of China, now is making a big shift, I believe. It's going to be a much friendlier orientation, an orientation which is going to be much more open, which makes me more bullish on the Chinese market. So on balance, the U.S. probably has come into a better position, but that doesn't mean the Chinese are going to be weak in terms of trade and that sort of thing.
So China's become more attractive. How would you be playing this market now? It does seem like, there's greater appetite for Chinese assets at this point in time. What's attractive, Mark?
Well, the technology is very, very important in China, and it's getting better and better. As you know, China has embarked on a program to be self-sufficient in chips and many other areas of technology. And that is going to be very critical for investors like ourselves. So we're going to be looking at companies that have a leg up on the US and Europe in technology. And as you know, if you look at the EV market in China, it's been incredible. I mean, you drive in a Chinese vehicle and it's better than a Rolls Royce. I had the experience recently of driving in a Rolls Royce, and then I got into a BYD, and the BYD was better. So you're in a situation now in China where the technology is getting better and better, and they're moving up the technology stairs.
Is there a convincing reversal in sentiment when it comes to investor sentiment in China? It wasn't that long ago when China was actually uninvestable, Mark. I mean, is this the catalyst?
Yes, I think it is a catalyst. It's not going to happen overnight, but you can see that the Chinese market overall has been outperforming surprisingly India. As you know, I've been a big supporter of Indian growth, and now China's outperforming India. And in fact, if you look at the recent numbers, the Chinese market overall is outperforming the U.S. market. So there's no question that we're now in a different era. It's going to take time for people to adjust, for investors to adjust, because a lot of people are still down on China. But I think that's going to change going forward if the current trends continue.
So we can expect a longer-term re-rating of China. Is that right? I mean, and if that is the case, what time period are you looking at?
Looking at this year and next year, you're going to see a re-rating of China. I mean, this is all based on the assumption that the current trends, the political trends within China continue, where the hardline wolf warrior kind of approach in China goes away. And the Communist Party now is saying, look, we've got to make it much easier to deal with the U.S. We've got to be more friendly with the U.S. And that's going to change many, many things.
Right. What's the biggest risk for China, Mark? I mean, investor sentiment changes with the headlines. That's how quickly they change.
Yeah, that's right. The big risk, of course, is if the wolf warrior stance that Xi has been promoting from the beginning of his term comes back. If that happens, then it's another game. But I don't think so. I think the Communist Party in the latest plenum realize that they've got to be friendly to the U.S. They've got to mend the relationship. And it's really interesting that in the meetings with Xi and Trump, Taiwan was not mentioned once, which is quite critical. That says a lot about relationships between the two countries.
I want to pull back and go back to what you were talking about, the U.S., that U.S. is the winner. Yet when you take a look at the market reaction right now, we've seen that sell-off. How are you making sense of that sell-off? Is it just a matter of removing some of the froth, especially in the AI space?
Of course, if you look at the AI space, it's a lot of froth. And we expect there to be a big correction in these companies that are emphasizing AI and spending trillions of dollars in AI improvements and infrastructure. There's got to be a correction because some of the numbers are just out of sight. So that is going to happen going forward. But that doesn't mean that AI is going to disappear. AI is still critical. But I think some of the infrastructure spending and other spending on AI is probably excessive. And there'll be a pullback on that.
What's a big pullback? What's a big correction? Some on Wall Street say, more than 10%. But what is 10% when you've risen more than 80?
No, I mean, when I look at a correction, I look at 30% down, 40%. That will happen. But it will be short-lived. I mean, that's the wonderful thing about these bear markets. The bear markets are much shorter in duration than the bull markets. And that's the reason why long-term investors, if they hang in there, tend to do fine. But I think we've got to be ready for a big pullback. When it's going to happen, nobody knows. Currently, everybody's euphoric. Everybody's happy. There are a few naysayers. But generally speaking, we've got to be prepared for a pullback.
And you buy the dip, Mark, if you believe that the long-term trend is still higher.
Oh, definitely. I mean, I'd love to see a pullback of 30-40%. Then we'll be in there with both arms and legs. We'll be buying a lot.
When you see this pullback in AI stocks, what is the value case for EMs? How do they play against each other, Mark?
Well, the good news with EM is because of the trade policies by the U.S., many of these countries are going to be producing and exporting the things that China has been producing and exporting. So if you look at Southeast Asia, for example, I think Malaysia is going to benefit from that. Thailand will benefit. Other countries, Taiwan will continue to do very well. Korea will do well. So this is a very, very critical development. And of course, India is developing entire hardware industry for computers and all kinds of electronics. So I believe that this change is going to have a beneficial effect. Now, that doesn't mean that China loses out. China is moving up the scale. They're getting rid of the low technology kinds of industries and moving up the technology scale. And they will, of course, be benefiting from that as well.
We've been talking about how we will see a rotation back to EM, but we've not seen a real rotation back. What catalyst, what's really needed for us to see that?
Well, if you look at the EM index, you'll see that it's done very, very well, outperforming the U.S. market, at least in the short term. And the reason for that is China. China represents such a big part of the index. But I believe India will come back. And of course, these two powerhouses will really make emerging markets look very good. And of course, that will swash over into other emerging markets. If you look at the rest of Asia, there are many markets that are doing quite well. Malaysia looks good. You can notice that the Malaysian ringgit is getting stronger against the U.S. dollar. The Thai baht looks pretty good. Of course, the other currencies are weakening against the U.S. dollar, but not by very much.
The trend so far, though, is dollar resilience, right? I mean, the Fed is not cutting as much as people thought it would. How might that impact on EMs?
Well, a stronger U.S. dollar is great for EM because they can then export and earn more dollars. So I would say that's a very positive development for EM. But you must remember, if you look at the US dollar index, it's now, after having come down substantially, it's now just beginning to turn. You begin to see the index moving up, and it's got a long way to go. It's going to be getting stronger and stronger. You see the Trump policy of strengthening the balance of payments of the U.S. and, of course, all of these tariff income by the U.S. The U.S. is earning now is going to have a big impact on the confidence of the U.S. dollar and the U.S. economy in general. So this trend has just begun, and hopefully, during Trump's administration, it will continue going forward.
There's also diverging rate cycles, right? We talk about how the Fed is quite resistant, but when it comes to Asian central banks, they've been more than willing to cut rates. That would work in EM's favors, no?
Of course, yeah. They take the lead from the Fed, of course, and all these countries, as the Fed comes down with interest rates, they'll be lowering their own rates, and that will be very good for the economies. So we're in a very nice period, but when you look at the height of the U.S. market, you get a little nosebleed because we've moved up an awful lot. But I think emerging markets will follow.
You talked earlier about India, how India will be, an emerging market driver. How do you make sense of, the attractiveness of the market, the resilience of the economy, GDP in excess of 6.5%, yet it has a currency that is amongst the weakest in the Asia-Pac region? What is that reflecting, Mark? I mean, is it actually reflecting fundamentals or not?
I think the problem with India is that despite the fact that it's got this enormous domestic market, the fact that they're moving very fast up the technology ladder, the problem is the bureaucracy. Putting money into India is a terrible, terrible process. It takes months and months for us to get money into India. For one of our funds, we've been working for 9 months to get approvals. So this is a big, big problem for India. The Indian bureaucracy is really killing the Indian market's ability to absorb more and more foreign investment. Many foreign investors want to get in to India, but they've been prevented by this incredible bureaucracy. So the degree to which they're able to correct that will really be very meaningful in terms of what happens to India. And of course, we're not only talking about dollars going in, we're talking about investments going in, we're talking about technology going in, et cetera, et cetera. So this is the big, big challenge that India now has.
So for India to be supported, for the Indian market to be supported longer term, you have to address the issue of bureaucracy. But shorter term, would earnings be the driver? Would earnings be, holding up Indian stocks, you think?
Well, it has. I mean, the Indian market companies have done very well, but they reached a peak where further growth was not possible. And that's the reason why the market corrected. And what is needed, as I mentioned, is more and more money coming in to the market, which I'm not only talking about the equity market, I'm talking about direct investment generally, companies coming in and investing. And by the way, part of this is China. India has to invite and welcome Chinese investment. Now, that may seem strange because of their fraught political relationship over a number of years, but generally speaking, China can contribute the kind of technology and manufacturing expertise that India can use to export all over the world. So and of course, China likes to do that because if they can't export to the U.S., they'd love to be able to establish a factory in India and then export to the U.S. So I think we're in a situation now where they have to do that.
How do you play the Indian market? We often talk about how it is a consumption play, right? This is 1 billion people. But there are opinions out there saying that, the Indians will probably get old before they get rich because, they're struggling with job creation and so on and so forth. How do you play best the Indian market?
I would say the way to play it is looking at the hardware technology. In other words, as you know, India has been an incredible producer of software. They've been exporting software all over the world. You have companies like Tata, Infosys are doing an incredible job globally exporting. Now they have to get into exporting of hardware, computer hardware. And that's the reason why this business of allowing foreign investment to come in and making it easier foreign investment to come in is very critical. Before software is no problem because you don't need an export permit to export software, but for hardware, it's a different story.
Mark, I just want to pivot somewhat to another emerging market, Korea. There was a lot of euphoria, right? I mean, a lot of money was being pumped into the Korean market, but it's also among the biggest losers with the sell-off. How attractive is Korea to you?
Korea is one of the most interesting of the markets right now for us. Next to Taiwan, I think Korea ranks pretty high. So we're looking at a number of companies in Korea because the Korean technology has really done very well. And in certain areas, interestingly enough, healthcare, cosmetics, that sort of thing, Koreans are doing very well.
But if you take a look at what's happening right now, the sell-off in AI, I mean, Korea is getting hit really badly. So the risks are high for a market like Korea.
Yeah, everybody will be hit with that. There's no question about that. But it doesn't mean AI is going away. They will still be developing AI, and they'll still be using AI.
What's interesting currently is how retail investors are driving the markets. We're not seeing that just in Korea, but in India and even in the US for that matter. Do you think this is a healthy trend going forward? Because should there be a sell-off, that correction of 30%, for instance, like what you anticipate later on, that could be damaging for these investors?
Well, of course, you've got to look at the U.S. market because U.S. represents about 70% of total equity investing around the world. And one of the developments that we've noticed is that the U.S. does not reflect necessarily the U.S. economy, but the global economy, because more and more of these companies, you look at Apple, you look at Amazon, you look at any of these companies, they're global companies, they're in emerging markets, and a lot of their growth in terms of sales and in terms of supply chain have been emerging market supply chain and sales growth. So this is, you've got to watch the U.S. market because U.S. market goes down, everybody will get hit.